Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you so much for joining us this week. We're going to cover some interesting topics. One is a continuation, but I think good perspective in terms of this market. A lot of headlines drawn, parallels. We're always cautious when doing that, but also at the same token, drilling in to see what we can learn and apply in terms of today's market. We're going to take a look at tech partnerships. Andrew just had a great analogy in the investment meeting, wanted to make sure he replayed it here, and then we're going to take a look at the fundamentals of those stocks. So I'll pass it over to Andrew to jump right in to those comparisons that we're seeing a lot more of 1999 versus today.
Yeah, so something that we're hearing a lot about from families in meetings, we're also seeing it in the media as well, is trying to draw comparisons to prior markets. This is nothing new. We often see, are we repeating XYZ? Oftentimes it's really perilous times. Is this the next Great Depression, the next financial crisis? Very rarely do we ever hear people say, oh, this is the next giant bull market. But we often get these questions, and so we like to give our perspective in the Market Carver to really kind of put the data to the question, as we always do. So the one that we want to look at now is the semblance or the resemblance of 1999 to today. So we can zoom in on these charts. What I'm showing here are the top weighted stocks at the time back in 1999 versus today. And this is something we've talked a lot about, how in the current market, we're really seeing heavy concentration. The top stocks are holding a lot of weight, a lot of importance in our market. And when we look back at 1999, one of the differences we see there is some of the biggest stocks. We had Microsoft, Cisco, but then we started getting outside of tech. Even though it was this tech bubble, we still then had Walmart, General Electric, ExxonMobil. We had banks like Citigroup. Then we had Home Depot. We had a fairly somewhat diversified top stocks in the market. If we come over to today, and this is where we get a little bit more perilous kind of the risk, pretty much everything is tech related. Nvidia, Microsoft, Apple, Alphabet, which is Google, Amazon, Meta, which is Facebook, Broadcom, Tesla, which is all pretty much a tech company by itself as well. And so we really have a huge focus on the tech space. Why this is important is because a lot of these companies are all working along with one another. We're hearing all these announcements that we've talked in the past in the Market Carver about the connection to AI, the importance of AI, and why Nvidia really has driven higher has been the reliance and announcements of the buying of chips, and how everyone's going to start needing more chips because of the AI renaissance. If we start looking at the next slide, we can kind of get an example of that. I realize there's a lot going on here. I'll try to break down what's important. So if we look at OpenAI, that's ChatGPT. That's where kind of what's getting all the buzz right now. They keep announcing all these deals. They announced one this week with Broadcom where they're doing partnerships. They're saying they're gonna do these investments. They did a big one with Nvidia, where they were gonna agree. Nvidia was gonna invest $100 billion in OpenAI, and then OpenAI said they're gonna do a $300 billion deal with Oracle, and Oracle actually buys a lot of their chips from Nvidia, and how all these are interconnected, and they kind of are heavily reliant on one another. And maybe a better representation of this kind of complicated chart here is the next slide. All right, if we look at the next chart, we can see maybe a little bit easier of a representation of all these deals working together. You can see this is kind of tongue-in-cheek, but it's basically a power cord that's drawing power plugged into itself. Why this is a representation of what's going on is we see that Nvidia invests in OpenAI, and OpenAI does this deal with Oracle, who's buying all their chips from Nvidia, and how they all are working together, and they all pretty much have to create and grow at the same pace, if not faster, to keep these deals funded. The deal with OpenAI and Oracle was the Hoover Dam. They'd have 2 Hoover Dams to power the data centers Oracle's supposed to have, and all these chips that they're going to get from Nvidia that really aren't even necessary quite yet based off growth projections. And we start looking at the details of these deals. It's very kind of pie in the sky, and really requiring one another to really work and grow even faster to make them make sense. And this gets really important because we start seeing the heavy reliance on these stocks. While we saw the bubble building in 1999 and the market did really well that year for the NASDAQ market, it was still fairly diversified. We didn't have such a reliance on just tech stocks like we do today. Now, let me caution, we're not saying that we're coming to the peak of a bubble or anything like that. We're not trying to make a dire warning. We just really want to kind of recognize that while we are seeing kind of this AI exuberance, we can't always say it's exactly like a prior market environment. And Adam's going to do a really good job. I'm going to set the bar for him high. A really good job discussing some of the fundamental differences, the positive and the negative that are shaping the current market. Again, looking back at that tech period.
Yeah, well, let's just start with, I mean, the reason that resonates so strongly when people look for parallels, and I think in some ways we as investors are continually train ourselves to look for those shoes that drop that hurt us so bad. That 99 dropout was painful for anybody who was over concentrated. So we're going to do two things at once. And on one hand, we got to recognize and respect, what happened the last time and other ones before that where markets became overly concentrated. If the investor in turn was also overly concentrated, the pain was severe. But then the other thing we have to also simultaneously do is not necessarily glue ourselves to an idea that we'll follow an exact parallel. And one of the ways in which we're different are those fundamentals underneath the market. And the earnings outlook is substantially different. So what you have here on the left panel, we'll start there. And this is the price to earnings ratio. So a very popular, convenient, and easy to understand valuation metric for not only the S&P 500, but those top 10, right? The source of that concentration, and then the other 490 companies. And so one thing that's different is if you go back to the early 1990s, we could see that the price to earnings ratio was way more out of hand. And that's because that hype was so much more on unproven ground on the internet. Yes, a lot of those internet companies became and laid the foundation for what would be the world we're living in today. But it was so far out before, so far ahead of the skis in terms of when the earnings were there, that it was susceptible to such a painful drop. Meanwhile, today, yes, stocks are more expensive. That is without a doubt, but it is nowhere near what we saw in that late 90s period. So the overall market itself, that gray line, is somewhere in the vicinity of that chart. But we can also see from the blue that there is plenty of stocks that were also, not quite to the peak that they were there back in the late 1990s. On the right, then, is both the earnings and the percentage of the market cap that those top 10 companies were. So again, if you go back to the early 90s, and this is a simple way to look at it, that green, they were such a small percentage of the overall index, while the stock value, they were well over 1/4. So that fundamental justification totally out of whack. Whereas today, yeah, those companies are well over that 25% mark. In fact, almost a third of the overall earnings. And not only that, but they are growing very quickly, at least for the time being. The entire question is really how long that goes. So we really want to, number one, recognize and look back to the past to see that parallel, but also look at this in terms of where the underlying fundamentals are. And it is a different picture. And in many ways, it's an optimistic one because of so much of the value that can be seen outside of those companies and for the value that is in those companies as well. So this is a little bit longer, but we think worthy to break down this topic a little bit more granular for you. So thank you. If you stuck with us through this mark, we sure do appreciate it. If we can be of service, as always, don't hesitate to give us a call, 800-928-4001, or scan the QR code and do so electronically. Thanks and have a great weekend.